Well, in today's fast paced and technologically advanced world, the landscape of trading and investment in India has undergone significant transformation now. We have with us Sujit Modi, who's CIO of Share.Market, who will take us through the cyclical nature of the market, exploring how the interplay of demand and supply creates noise and signals that investors must navigate. Now, we also explore the unique offerings of Share.Market, particularly their innovative Wealth Basket, which bridges the gap between small scale investments and large portfolio management. Now, Share.Market, which is a groundbreaking platform that is revolutionizing discount broking by integrating comprehensive research and intelligence. Now, unlike traditional discount brokers that primarily focus on low cost trading, Share.Market elevate the experience by providing users with in depth market analysis, expert insights, and data driven strategies. Welcome to the show, Sujit.
Thanks, Shite. Appreciate you having me here.
Thank you so much for your time, Sujit. Now, in the let's quickly understand how significantly have the advancements in tech altered the way people trade in India. Now, why I say that is because in the last 2 to 5 years, with the insurgence of mobile internet or the internet, you could say that all around. Uh, the shift has taken how we consume content and how we trade from desktop to mobile. And that has actually given a flip to the technological advancement. So if you can just elaborate on that part.
Well, yes, Shite, when I started my career 20 years back, research or investment management broadly involved three different steps. That is data collection, data storage, and data processing. 20 years down the line, these three broad steps have not changed much, but their manifestation have changed significantly. So earlier, we used to have a team of 10, 15 member team that used to collect data through annual reports of companies, P&L, cash flow statement, notes to accounts, and so on. And we used to key those data into Excel. There used to be different Excel file for different companies, different sectors. And
Right.
from that data used to flow into a model template. There used to be a different template for financial companies, non-financial companies, and so on. And then the template used to throw up a number, which used to be a valuation number of the stocks. 20 years down the line, the data that we used to collect from annual report is available to you through data vendors in the form of a database, which is available to you on a plug and play basis. You simply need to plug it into your downstream process. The data storage, which used to be in Excel file, has now gone on to cloud. Databases are sitting on servers which are auto scaling. There are functions for the service available. The whole business model, where earlier the tech used to be a capex, has now it's becoming an opex, right? So what used to be a balance sheet funding item has now become an operating profit driven item. And data processing, which used to be an Excel based template, has now given way to software like Python. And the way the business model has gotten flipped is earlier the 10, 15 member research team has now gotten shrunk into 2 or 3 member research team. But the demand on skill has gotten up. Now, a new age research guy is supposed to know programming, data, cloud, data structures, on top of domain in terms of what is DCA, what is P ratio, and so on and so forth. So I think technology has fundamentally altered the way research and investment management is being looked upon. And I think this positive disruption is going to stay here, and it is only going to compound from here going forward.
Absolutely. In fact, the positive disruptions lead to better investment ideas and better profitability for the investors. Yes, that's a valid point because in fact, if I also look back when I started with my journalism, or you could say when I started investing back then, yes, there was a handful of things that we used to do, but now we are doing those things in a very quick time because
Right.
a lot of it is now product based, and those products are delivering us the value at this point in time.
I
So
mean,
yes.
there are new lingos coming out now. We have ad tech, food tech, martech, fintech, everywhere. Right? So we're talking different these days compared to what we used to 20 years back. Yeah,
Absolutely, absolutely. So we have to adjust to the Gen Z lingo, to be able
correct.
to accommodate in this investment environment, right? Well, moving on, so let me also understand from you now the cyclical nature of the market. This is a phrase that is, that sort of immediately catches your eyes when we go through an article of your, published last year. Now, does that mean the changes in the stock market investments and tradings are reversible? Is this something the investors should be aware of?
Both yes as well as no. We see when we talk in terms of share prices, no share prices, is determined by an interplay of demand and supply. And
Right.
this gives rise to two very important attributes in share prices. One is noise and another is signal.
Right.
By definition, noise is supposed to cancel out each other and signal is expected to perpetuate. But there's a third and very important element of time. So what is noise in one time frame can become signal in another time frame and vice versa. So
Mm.
that article, I was actually trying to promote the framework of factor investing, which very
Right.
beautifully captures this triangle of time, noise, and signal together. And
Hmm. Hmm.
I used the comparison between valuation as a concept and value factor as a metric.
Right.
How far the reversibility is concerned, the noise part will definitely reverse depending upon the time frame, but I think the signal will perpetuate. And in today's time, I think the entire investment management industry is geared towards one thing: is trying to
Hmm.
isolate noise from signals. So yeah.
Right. In fact, Sujit, for the benefit of our viewers, if you can also elaborate the noise. When we say noise, what exactly it means is, does it mean the external environment which is impacting the stock price but not related immediately? If you can just highlight on that.
So you see, in the long run, the investment or the share price should reflect the earnings growth. But a lot of time we see that the share price is not in sync with the earnings of the companies. They are either way too high, that is, they are very expensive,
Hmm.
or they are very cheap. There's a value trap and so on. Now, if it is very high, you plug in the growth parameter to it, and then probably it becomes fairly valued. Or there is some liquidity push that is coming from central banks, which
Right.
typically we have seen post 2008. The playbook of central banks have completely changed. Whenever there's a crash, we see liquidity coming into the system. And if it is a liquidity-driven asset inflation that is giving rise to growth in share price growth, that is a noise that at some point that is supposed to cancel out, and eventually the earnings play should start playing out. So I
Right.
think that's the difference between noise and signal. But having said that, if you are trading, let's say, on a 1 minute or a 5 minute time frame, then these
Hmm.
is a signal for you because you're trying to catch the price pattern, right? So that's why I said there's a time element to it. So for a 5 minute trader, the noise is the signal, but for a 5 year investor,
Right.
signal is a signal. It's not.
Signal is something that you can count on and you can eliminate the noise. So yes,
Yeah.
right. So the trader and the investor. For investor, the noise and signal mean different things, and for trader, noise and signal would mean different things. I hope viewers would get this. Get this understanding and about the noise and the signal part, and don't get confused, because yes, it's very relevant to the stock moment. Now, in the meantime, I think so you did talk about the factor investing part, earlier in the conversation. Can you also elaborate on the factor investing, and what is it all about, and what share dot market is doing?
Right. So instead of getting into the technicalities and jargon part of it, let me try to kind of talk in a simple layman's language. You
Sure.
see, whenever we buy anything in our life, whether it's an FMCG product or a real estate product or a stock in the market, there is a certain framework that we follow, right?
Right.
Whether you're getting a good thing at a good price, whether this will gratify you in terms of your need and so on. Applying the
Mm.
same thing in stock picking, you see, when I want to buy or put a money into a stock market, it is broadly I'm trying to answer two questions: what to buy and how much to buy. What to
Right.
buy is related to stock selection. How much to buy is related to capital allocation. Now, what to buy is essentially a 3 or 4 step process, in the sense like whether a stock is a good stock or not. Whether it's a good stock or not, we are talking of essentially quality in the company, and we determine quality by analyzing the balance sheets of the company, the stated numbers. Because
Right.
these are stated and frozen numbers, the quality factor changes very slowly, like once in a year companies. So something like, if Apple or Google or Reliance, they will have to work really hard to fall from the throne that they have come to occupy over years, right? So a
Right.
quality company will continue to be a quality company for a very long time.
Okay.
Then the second question is whether a good company is a good investment or not. That is,
Mm.
whether a good company is available to you a good price, is where we start connecting the fundamentals, the stated numbers, with the price of the stock.
Sure.
And because we have brought in the price element, which is very dynamic, the value factor is slightly fast moving compared to quality,
Right.
right? And then there's a third question that we try to answer is whether a good investment will give you good returns or not, because not all good investment gives you good returns. And over here, we try to see price action in terms of what is the structure of the price action, whether it had been a secular trend, a lot of volatility driven, and so on. Now, because in third question, we are isolating fundamentals from price completely and completely focusing on price action, we call it momentum. It is relatively faster moving than quality and value.
Right.
And then fourth and final is you would want a third party expert to validate your analysis. So that is where, and who's an expert who knows the company apart from founders and insiders are the analysts, right? So we rely on something called analyst sentiment factor as well. Now analyst numbers keeps changing every 3 months as the company's quarterly numbers comes out or any guidance numbers comes out, and we connect them with the share price. So this is even faster moving than the momentum. So when I said that factor investing as a framework contains very beautifully captures time, noise, and signal, right? So sentiment could be a noise for someone who is focused completely on quality driven investing, and quality could be a noise for someone who is completely sentiment driven trader, right? So there is a framework that works for everyone. You pick and choose what works for you. The good thing about factor investing is the whole knowledge is so codified and objectified and de-jargonized that you can actually standardize everything. You can compare one stock from one sector with another stock in another sector, because when I'm putting my money in markets, I don't really care whether my return is coming from HDFC or Reliance, so long it is coming from any other stock, right?
Exactly.
Because of this standardization, the comparison becomes very easy, and the relative selection of stocks becomes very objectified and structured in that way.
No, absolutely beautifully put there, Sujit. In fact, so if someone is a technical trader, what noise and what signal one should be taking? If somebody is a fundamental or long-term investor, what exactly is the noise and the signal? And in fact, if you're able to club all these factors into one parameter, then and it's comparable across various themes, because each industry would have different factors to look at, different factors to evaluate. I think that's a very beautiful thing to have, and our retail investors would definitely would want to get their hands on a product like this, because that would facilitate intelligent decision making, as well as maximizing profitability in the long run as well.
Sure. Yes.
Right. Now, in the meantime, share market is there, but then there are other established players as well in the industry. If you can also elaborate on what are the unique aspects that share market brings to the table in a competitive market where it competes with established players.
So how far structure of the organization is concerned, we are structured as a broker, and because we are a tech first, efficiency gains that we extract out of the process, we pass it on to our customers. We become a discount broker. But the way we look at ourselves, we offer three different kind of offerings to our customers. One is investment solutions in the form of WealthBaskets, collections. Then there is analytical solutions in the form of factor investing. Each and every stock pages that is available on share market app or web, there is a factor analysis section. Somebody can come and take a look at it. Then from a trading side, we have gone live with option chain. And on the analytics front, there is many more features and products that are on their way. And finally, as a broker, we provide execution services because providing connectivity to the exchanges is our prime offering. But at the same time, we provide enough information so that you don't only get connected to the exchange, but you can actually trade intelligently and in a disciplined manner.
Right. Now, in the meantime, in the conversation, we've heard the WealthBasket a couple of times, and I'm sure that's the primary or the more premium product that share.market, have at this point in time. If you can also quickly elaborate or explain it to our viewers, what does the WealthBasket means for investors?
Right. So, WealthBasket is nothing but a group of stocks or ETFs put together in certain proportions. Now, whether you call it basket, you call it portfolio, you call it index, you call it strategy, these are all semantics. At the end of the day, a bunch of stocks selected from a certain discipline and put together in a certain way. So then the question is, if it is nothing but a bunch of stock, there are so many portfolios out there in the market, why at all is the need for a product like WealthBasket? So To answer this, let's look at the India's investment landscape for a retail customer, right? An individual retail customer can start his investment journey with as low as rupees 500 by opening an SIP with mutual fund, which is a
Right.
regulated structure and with enough guardrails.
Mm.
After 500 rupee mutual fund, the next regulated structure available is PMS, where the minimum ticket size is 50 lakhs. Now,
50
recently,
lakhs.
SEBI came up with a new asset class guidelines where they are trying to bring down
Mm.
the minimum investment within 10 lakhs. But as of now, between 500 and 50 lakhs, it's a huge market which is very disorganized.
Right.
And individual retail end up buying stocks either through some advice from somebody or by using his own understanding of the markets. So
Mm.
our objective of introducing something like WealthBasket was to bring in some organization within this 500 to 50 lakh market segment. The benefit of WealthBasket is that you get a portfolio approach to investing, which is far more disciplined. But at the same time, you have the feel of individual stocks because WealthBasket constituents end up in your Demat account as an individual stock. So if you are not happy with any of the recommendation in WealthBasket, you can take them out, you can reduce their
Oh,
weightages, or you can simply
okay.
play along with whatever the WealthBasket process has recommended you.
Mm.
So the core of stock selection logic still is coming out of framework of factor investing we just discussed, but there are some 3 4 design elements that has gone into it just to provide additional guardrails. First is the self corrective mechanism is built into the process itself, in the sense like
Okay.
any portfolio manager or a stock picker can go wrong at some point in time because
Right.
at the end of the day we are dealing with markets. So in case if a stock does not perform as intended, then the
Right.
process will start weeding out that stock on its own and start replacing it with the other high probable candidates.
Right.
Second is we particularly look at the risk reward ratio of well baskets vis-a-vis the market or the index. If your risk reward is favorable than the market and your
Mm.
holding period is lower than the market average holding period, then
Mm.
over the cycle your relative performance will be better than the market.
Okay.
Right. And we are in a relative business, so we actually tend to outperform the market. So these are the guardrails. And the last most important bit is the profit booking part.
Mm.
A lot of time we say that market has gone up, it will go further up, let it continue. But there is
Right.
a point where you should start booking some profit, and there is a methodology or an algorithm behind it. So the profit
Okay.
booking itself is built into the well basket process. So you see, stock selection, risk management, and profit booking, the 3 main elements of your wealth creation journey is built into the process itself. And then it gives you a look and feel of individual stock with the benefits of portfolio. So I think that way it's a very powerful tool or a product that a retail customer should look at.
Right. And that's all data driven. The wealth
Completely,
basket is powered by data. Yeah.
completely 100% data driven, no manual intervention.
Oh wow, wow, that's very interesting, and I'm sure the next question which investors might probably have in their minds is what about withdrawals and is there a lock-in period? Because the themes that you mentioned, mutual funds and PMS or AIF, they normally do come with their own lock-in period. So, any word on that?
No, there's absolutely no lock-in period, even though we recommend to hold it for at least 3 years so that the
Okay,
market cycle can play out. But if there is some reason, some exigency that you want to withdraw, the stocks are sitting in your Demat account. Only thing you need to do is go and sell it off. So yeah.
right. Now, well, basket does look very interesting, and I'm sure once retail investors get the hang of it and start using it, they'll see the kind of benefit it delivers to them over a period of time. And like you said, that it's better to play the whole market cycle instead of just being invested for a short term. Now, Sujit, I was also actually reading one of your other articles, and you did talk about not putting all the eggs in one basket. Now, you equate a basket with securities and trades with sectors in that article. So it is an interesting read. Can you please elaborate on that concept as well?
Yeah, so actually, I was talking about diversification in that article. Typically, people look at diversification that in the name of diversification, you should end up adding more and more stocks in the portfolio so that your
Right,
risk particular stock ends up reducing. But then, there are no free lunches. If as and when you keep adding more stocks, you start diluting
right,
the returns of your portfolio as well. And
right.
there is a very beautiful paper which was published in back 1977, 78, even I was not born at that time. since the understanding is that after 8 to 10 stocks, the benefit of diversification starts diluting. If you are adding more stocks, you are only diluting returns, because diversification is more related to the correlation of stocks within the portfolio rather than number of stocks in the portfolio. Now, when you're building a diversified portfolio, you can put negatively correlated stocks, negatively correlated sectors, and so on, but they can still be a positively correlated factor.
Okay.
So let me try to explain that with the help of an example. Let's say if we talk of 2008 GFC, global financial crisis, and I'm using this example because I've seen that crisis from very close quarters at that time.
Right.
Now, let's say you are holding HDFC Bank or ICICI Bank in India, which is a universal bank. Then let's say you have a NatWest in UK, which is a commercial bank, and then let's say you have a Goldman Sachs in US, which is an investment bank. So from the traditional diversification principle, you are diversified how far stocks are concerned, how far sectors are concerned, and how far geography is concerned. But in 2008, all three of them were very badly hammered because all three of them were having a single factor called CDOs, collateralized debt obligations, right? So and this common factor is nothing but your tray. If your tray is upset, no matter how well your dishes are placed on that tray, the dishes are going to get upset. So the point I was trying to make through that article is that when you're looking at diversification, while stocks and sectors have been talked about a lot, it is important to look at from factor diversification point of view as well.
Right. Now, in fact, if you can also highlight in what way we can do that, because I think that is something which investors would want to understand. So when we're talking about diversification, then in that concept, or are you talking about the wealth basket, or is there another product that you're talking about?
So this was a concept. How far the WealthBasket bit is concerned, when we spoke about principles of factor investing, quality, value, momentum, the WealthBaskets are built like that. So now value and momentum are negatively correlated factors. So the way it works is if the price is coming down, the value in the stock is going up, right? And if the price is coming down, which means momentum is falling. So they are negatively correlated. And as we discussed that. You want to choose whether a stock is a good stock, good investment, whether a good investment can give you good return. So the negative correlation is built into the framework itself, right? So when you're picking stocks or wealth baskets, this process itself ensures that you are getting stocks within the sector, which if there is a secular trend, then the best performing sector will anyways end up into your portfolio. But if the market is sideways and if there's no secular trend, then the stocks which are playing out in different pockets of the market will start coming into your portfolio. And you can validate that because if you look at the standard deviation of some of our wealth baskets, it is very similar to the benchmark Nifty 50 or Nifty 500 standard deviation, and those are diversified indices. So this negative correlation and diversification is again built into the wealth basket process itself.
Great. That's very interesting, and I'm sure our retail investors would take note of that. And in fact, Sujit, throughout the conversation, we've consistently talked about intelligence. Now, is it fair to say that intelligence will be a key growth driver for the stock market industry?
It's not just intelligence, Kshitij. I think intelligence simplified is the term that we should use because there's still so much of intelligence around, but because of the jargons that are being thrown at retail customers is where the confusion starts happening. So if you can compress the intelligence into simple to use consumable terminologies, which are codified and standardized, and that you can disseminate at scale using the benefits of technology, I think that's the play eventually, which will differentiate from someone who's a late entrant but end up making a space for himself in the industry versus the incumbents who are already there.
Right. Now, in the meantime, if you can also elaborate now, when we're talking about the intelligence, are you talking about the intelligence in terms of the jargons that we are using, or the parameters that you've used in the app to simplify investment process?
Yeah, so the terminology that we have used is what you see. Everybody understand what is quality, right? Right. From the quality ice cream to the quality toothpaste to the quality stock, right? It's quality. Everybody understand. India, by and large, had been a value pickers market for very long, right? So value also everybody understands. Momentum could be a new terminology, but I think the generic definition of momentum, a lot of people will understand that, okay, what is moving continues to move, that's the momentum. And sentiment is again it's a generic English terminology. So while under the hood, the a lot of testing, analysis, and intelligence has gone in, but the wrapper around it, we have kept it in the terminologies which are very generic, and these are not our terminologies. These are globally accepted definitions. How far the terminologies are concerned, the underlying definitions or under the hood intelligence could be different for us versus some other global players. Yeah.
Right. Well, on that note, thank you so much for your time, Sujit. And it was a pleasure speaking to you and how you demystified factor investing, highlighting the importance of quality, value, momentum, and analyst sentiment in stock picking. Thank you so much for your time.
Thank you so much, Hitesh. Very nice talking to you.